All right, welcome to episode 17 of Trade Secrets. We have a guest today, third guest, I believe. Super excited about David Mitros from Schneider Downs, and we're going to talk taxes at some point today. But before we do that, we're going to get into our current event, which is near and dear to Paige's heart-ish. She's wanted to talk about this a lot in the metaverse. And we're not there on
very different. I think the metaverse is over already. I'm not real sure.
I don't think it's over. CB just announced they were going to have an office in the metaverse. But blockchain and Bitcoin, there has been some huge news recently. FTX, which was at like $3.1 billion, just filed for bankruptcy maybe 3 weeks ago. Today, BlockFi filed for bankruptcy. What do you guys think about the wild world of
first,
Bitcoin?
I have a question. I mean, I don't know if anyone here knows the answer, but you said at $3.1 billion?
Yeah.
But didn't Sequoia alone invest over $32 billion into FTX?
I think the number was higher than $3.1 billion.
Well, that's what they owe to their creditors when they filed. Oh, no, I'm sorry, just to their top 50 creditors.
Okay. Well, either
Irrelevant.
way. Irrelevant.
It's a lot of money for
a lot
make-believe.
of money, kind of ironic. Another one filed for Chapter 11, I think today, right?
Yeah, BlockFi.
I should have spread out my articles so that I can actually read it. So I think the reason I thought that it would be an interesting thing to talk about, and we don't really even have to talk about it that much, but the tax implications, because that's what we're talking about today, of capital losses of that caliber, and how the implications of that versus tax write-offs for capital losses when it comes to investing in real estate.
Yeah, but let's not go there yet. I mean, what?
Okay.
Like
Well,
the whole. Like,
that's the roadmap.
Yeah, that's the roadmap. But you
I also
were
thought
like
we were
so
gonna let
fast.
Dave talk about who he is and what he does first too.
We're going to when we get to
Okay.
taxes. This
You
whole
just
thing
sit
has been
tight,
off the
Dave.
rails. Oh my gosh, it's Kelsey's birthday today. There's nothing on the rails. But yeah, so I guess since Paige didn't want to talk about Bitcoin, Dave, what's your take on Bitcoin after you give us a little brief introduction on your background and your role at Schneider Downs?
Yep. Dave Mitros. I'm a shareholder at Schneider Downs. Focus a lot of my time working with real estate investors, real estate developers. So I assist those clients with their annual tax compliance needs as well as planning and projections. And I've got this deal happening. What would be the impact to me and my investors? So we assist our clients with a lot of help from a planning perspective, in addition to just doing the tax returns each year. So I've got several years of experience in that industry at this point, and it's something I've really enjoyed during my time at Schneider Downs.
And for those listeners that aren't here in the Pittsburgh region, Schneider Downs is how many people?
We've got 400 or so in Pittsburgh and 100 or so in Columbus, Ohio. We're the biggest regional firm in the Western Pennsylvania region. We're in the top 4 in terms of number of professionals within Pittsburgh, including Deloitte, PwC, etc. So we have a big presence in the market, locally owned, have a lot of great local clients, and it's been a lot of fun.
Great. And national expertise with a local flair is how I would describe it.
Yep.
So, well, we're pumped to have you here. But, before we get into the whole real estate tax stuff, have you guys seen any clients exposed to this Bitcoin experience, and for the good or the bad or the ugly?
It's interesting. Several of my friends or otherwise colleagues have maybe invested in Bitcoin over the last couple of years, and they've had a little bit of a roller coaster ride. I don't see a ton of my clients investing in Bitcoin. Read into that what you will, but it is a question we need to ask every year, because it's not, or historically has not always been reported as easily to us on a 1099 at the end of the year that shows all your tax gains or losses. So
is it like a standard question now on the
it
annual?
is.
Oh my gosh, that's crazy, right?
And I typically only I won't say only, but I typically make sure I ask that question to my younger clients, who I feel have more potential to potentially invest in something like Bitcoin. So, not a ton of experience in terms of reporting or seeing what kinds of gains or losses have been generated for my clients, but certainly am aware of the roller coaster ride of the value of Bitcoin and cryptocurrency over the last few years and how that may impact a taxpayer. There's been a lot of guidance and regulation and information from the IRS in terms of how to treat that type of an asset in your reporting on your tax return.
How is it treated differently from any other taxable event?
I think generally it's going to be treated similarly to if you own stock in a public company.
Yeah.
So you've got your basis, your buy-in amount. If you trade out of it or sell it at a value higher than your basis, you're going to recognize a gain. That's going to be a capital gain. Potentially, if you sell at a value below your basis, you're going to generate a loss. And with those losses come all the same limitations that you might have on capital loss deductibility in the year of event that could potentially hang up some of those losses if they're significant.
I mean, at the end of the day, isn't it really just like penny trading on a really easily accessible platform?
With the idea that you can accumulate a very large amount of pennies in a very short period of time.
Like a
But
friend
then
of
the next day, the pennies might be good as air.
right.
Worthless.
If
A good
Yeah.
friend
thing
of the
you're
friend
buying pennies for goes away.
just told me that they, with hundreds of dollars invested, I don't think it was FTX, I forget which currency platform it was, just paid off their house. So it is real, but then you read these articles, which again, who knows? This is a splash media, but
Yeah, is that the thing that you always hear where, oh, he just made a killing in Vegas? Well, that doesn't tell you all the 20 times you went to Vegas and left with, cab fare. It's such a volatile thing, and currency in and of itself is a difficult thing to figure out. I mean, how valuable is United States currency? We'd lose in value daily, and
But at
yet
least
the
that's
highs
stable.
and lows
I mean,
stable
until
ish.
when
Well,
compared to crypto. If there was no crypto, we'd be talking about our currency is,
Right.
a little questionable. Let's just say.
all right, are you long or short? Are you buying or selling crypto?
well, don't you
I'm
have
not
to
even
have it
getting
to
it.
sell it?
I mean, right now, are
You
you
buy it,
you,
It's a-
you think it's going to
that's
be
a no
here?
for me, dog.
You're out?
I'm out.
The youngest person at the table is out.
I am completely out. I was never in. I don't understand it. No, I don't. It's to me, it's the ultimate shell game, and nothing against. I forget what the guy's name is. The couch potato with the fuzzy hair. Just. I mean,
Who?
just if he's the guy who
SBF.
just the guy
SBF,
who's
yes.
what's his name?
Sam Bankman-Fried.
Bankman-Fried?
Yeah. For somehow to say that guy is worth a couple of $1 billion and worth investing our hard capital into, I'm just not buying that.
This is wild.
Put me down as a solid no.
He was a real soft no, Michael.
Yeah. So
Yeah.
we'll put you down as a baby.
I'm a hard no, but I feel like I'm going to regret it.
Mm.
How about you?
I'm a hard no, and same reason. I don't really understand it. Haven't spent a lot of time trying to learn it. I'll try to live with no regrets.
Yeah.
And he likes to play with real money.
Yeah.
also.
Yes, accountants
I,
usually
I,
like to
I,
play
I
with
can't imagine
money.
that your clients that are in real estate, physical, tangible assets versus something that lives and dies in the ether. Nah.
That's a great transition because we wanted to talk about, the whole topic today was the tax advantages of being in real estate that don't exist in investing in Bitcoin per se.
Or even the stock market
Yeah.
necessarily.
Right.
Because we've had clients who've said like, well, if I'm realizing a 9% cap rate on the disposition of this asset, like, and not to say that this is a correct statement, but was my money and time and effort and energy, would that have been better spent in the stock market? And I think in instances like that, there are, cost segregations and write-offs, that might be the wrong term, that do make real estate a more attractive investment, or maybe a worthwhile way to diversify an investment portfolio. But I am like just scratching the surface of my knowledge and understanding of these implications. So while taxes depress me, I know I have a lot to learn, and I think it is very interesting, and I think that even more green investors maybe don't understand the way that they could utilize these accounting tools to their benefit.
Yeah, so Dave, from your perspective, what are like the big buckets of advantageous ways to use real estate to your benefit in the tax world?
Yeah, there's a few different large strategic things that you can do from a real estate investment standpoint in taxes.
Can I pause real quick
Yeah.
just to make sure the audience understands? This isn't investing in your house,
Correct.
right? This is investing in a investment real estate outside of your primary residence.
Income producing.
Right.
Yep.
Well, hopefully income producing.
Yeah.
Though, as you've segued there, though an investment into your own residence is probably one of the best thing a young person can do tax-wise.
Yep. Yeah, and so there's, you can think of this two different ways. As Michael said, you've got your personal residence, which affords you different deductions that can help reduce your tax liability on an annual basis. When we talk about income-producing investment properties, that can be land, that can be commercial, it can be hotels, it can be storage units, trailer parks. That you can see there's a whole wide, broad variety of what real estate investment might mean to an individual, and certain people have different strategies on what type of asset they might invest into. But
And does it have to be direct investing, or can it be investing through a fund or a REIT?
Yeah, so very good question. REITs are common, treated very similarly to publicly traded stock as far as how you invest in it. There's certain tax requirements and metrics that have to be met for a fund to qualify as a REIT. The type of entities that I do a lot of work with are, you could call them like private placement, if you will.
Okay.
You've got a developer that's got a property they're eyeing up to purchase or otherwise develop, and they go out and they solicit capital from friends, family, colleagues, people around town. Investment management firms can help source some of that capital, where you end up as a partner, a limited partner in the entity that purchases the property.
So whether you own 1% or 80%, you actually own a piece of the bricks and the sticks.
Correct. Yep.
Okay.
Yep.
In that form, but in a REIT form, you own
The REIT.
the REIT.
Right.
A piece of the REIT.
Yeah, that's why I wanted to make sure we understood with the audience. We're talking about actual direct investment, private placement in real
Because a
estate
REIT would
today.
be more just like an investment in a stock,
Yep.
right?
Correct.
Yep.
Okay.
It's just secured by
Yep.
Jeez. Sorry.
Real estate.
the
right?
real estate.
Oh my god, I did it again. Okay.
And then, of course,
These were the wrong shoes.
you could have individuals that went out and bought the house down the street and became a landlord, own a residential property that's hopefully cash flowing for them, and that's another way you can do it as well. There might be some legal things that would cause you to maybe form a legal entity to purchase that property.
Okay.
But from a tax perspective, if you're the 100% owner of the house down the street, you rent it out to a third party, it's going to be treated as your property on your tax return.
Great. All right. So what are those advantages?
So
Potential advantages.
yeah, so we'll think about this maybe to frame it a little bit. A lot of these advantages from a current standpoint on your annual tax return, I'm going to talk about them as if you can take advantage of them each year. And typically, if you're someone who has invested in rental real estate, to be able to take some of these advantages or deductions, currently you need to be designated a real estate professional. And we could go through what those metrics are, but that would be someone who spends most of their time in a real estate industry or some sort of an adjacent business. So Kevin, you would be a real estate professional.
Mm-hmm.
What that designation allows you to do is to group all your rental real estate activities into one activity from a tax standpoint, and if you meet certain hours thresholds, we'll call it 500 hours, or you are the person that's performing the majority of the activity related to the maintenance, upkeep, etc. of those properties, then you can treat those rental properties as non-passive activities, meaning all these tax advantages that we talk about, you can use them currently and offset other buckets of income. So if you earn a W-2, you could offset some of that W-2 earned income. So we'll talk about it from in that frame of mind, just to sort of set it here. But so I've got my top 5 tax advantages to investing in real estate, and one is very simple. Operating expenses are deductible. So your leasing costs, your marketing costs, travel, repairs and maintenance, utilities, if you have to cover utilities, all are deductible to offset the gross rents that you might bring in a given year. Mortgage interest, similar to your personal residence, but any interest, it doesn't even necessarily need to be a mortgage per se, but mortgage interest would be deductible to offset those gross rents. There are potential situations where there could be some limitations on the amount of interest that you would be able to deduct in a given year, but there's some ways to get around that, making certain elections.
I don't mean to jump in, but that's just based on the size of the portfolio, right?
Correct.
This cap is $750 or $1 million.
So that would be on your personal residence. So in your personal residence, you're going to have a limitation on your mortgage interest deduction capped at the interest associated with $750K of
But
debt.
staying in line with the commercial investment, what is the cap?
So
certain
certain taxpayers, and we'll talk about maybe as an individual. If you're an individual and you meet certain thresholds as far as the gross receipts that you or your businesses generate, you might have a limitation on the amount of interest that you're able to deduct, and that cap is, I think, $26 million in the most recent tax year. So most individual investors aren't gonna hit that cap. So if that's the case and you don't hit that gross revenue threshold, all of your interest, no matter how much debt you have. So let's say you've got one commercial property and you've got $2 million of debt, and you're not generating through yourself or your businesses $26 million in gross revenue, then all of the interest associated with that $2 million of debt will be deductible.
Mm-hmm.
So just to play that out in the real world, even though interest rates are rising right now, the benefit of interest rates rising is all of that expense is deductible.
Yep.
So it's very different from Main Street, where interest rates rise and your cost of capital is rising and you're not getting any direct benefit from that increase. The real estate investor is, if he has more than in the Main Street world $750,000 of debt, able to dollar for dollar reduce tax liability by the increased interest, right?
But the proviso is that you have to have the income
To carry it.
to carry that and to take the benefit of that.
Correct. Yeah. So you've got a cash flow enough to cover those payments.
But then you get the benefit of
You get
reducing
the benefit of reducing.
Yeah.
And in the perfect scenario, you're cash flowing enough that you can make all your payments and generating a little bit of a cash flow return. But from a tax perspective, you're generating losses through interest deduction and depreciation, which we'll talk
And
about.
in any scenario like that, in typical mortgage interest expense, the bulk of the interest is paid in the front portion of the loan.
Yep.
So
the big benefit comes in the front.
Correct.
So we've only covered 2 of your top 5, and we've already outlined a scenario whereby you could be invested, cash flowing, and from a tax perspective, showing net losses.
Oh yeah.
Yeah, it's a beautiful thing.
Yeah.
Life is good.
Yeah.
Can't do that in Russia.
And Paige, up until 6 months ago, which shame on Michael and I maybe, but up until CCIM 101, this was a foreign concept.
Well, that was 2 months ago, but nope. Yeah.
In round numbers, within the last quarter or 2.
Right.
Foreign concept.
Yeah. Well, I had heard mention of it. I had heard deductions for interest, deductions for depreciation, but I didn't until you actually work through all of those numbers, you don't see how significant that can become.
Yeah.
if done correctly. And I think, and maybe it's because we're not accountants to our clients, but a lot of our clients, I don't even know that are taking full advantage of this.
No, they probably aren't. The ones who
Yeah.
are asking us for tax advice are definitely not taking advantage of it, because our answer is call Dave. No, it's just call Dave.
Yep.
Okay, so that's two.
To number 3.
And that leads into maybe something that's low-hanging fruit that folks like you can suggest to your clients is, depreciation. This is number 3. But more importantly, or specifically, a cost segregation study. So a cost segregation study will take a look at the building that you've invested in or purchased. And in the tax world, we've got different buckets of assets. So you've got your building, you've got your land, and you've got all what we'll call the personal property that goes along with it. And so your land, not depreciable, so you want to limit the amount of purchase price that you would allocate to the land asset. Your building, generally depreciable over 39 years, straight line, no acceleration on that. Any equipment that's within the property, and that can be machinery, it can be, if it's a hotel, it can be all the furniture and fixtures. You can take bonus depreciation, what we call bonus depreciation, in the year that those pieces of property are purchased. And so most recently, and for the last few years, that bonus depreciation rule allows you to expense 100% of the cost associated with those qualifying assets.
In the first year.
In the first year, yep.
I don't mean to just rub it in, but that's part of the trunk tax cut.
He was hell-bent on getting that guy's name in on this podcast today.
No, I'm just saying. But you see the tax
tried to talk him
advantage
out of it,
of
but we couldn't do
expensing
it.
that within the first year.
Wasn't that a bipartisan CARES Act thing? I think
I
fact check me,
all right.
but didn't it come
I'm getting-
out in the
I'm
CARES
getting a
Act?
little
There was
older
a
and my hair is gray, but
significant
yeah.
there was a significant clarification for real estate investors that was made in the CARES Act. And that is what we call qualified improvement property. And so this qualified improvement property was when TCJA was first drafted, this category of property was left out of what would qualify for bonus depreciation. And what qualified improvement property has come to be known as is any improvements to non-residential property to the interior. So it can't include elevators, it can't include structural things like the load-bearing walls, etc. But all your fit-outs, your drywall, your doors, your cabinetry, whatever it may be, that is what we would call qualified improvement property. And as part of the CARES Act, they fixed that, and there is actually an opportunity, and I've got an example what we might touch on where I talk about cost segregation and some of those benefits, but they fixed that as part of the CARES Act in 2020. You lose track of these years now. And it allowed taxpayers to go back and fix or amend 19 returns to take advantage of all this qualified improvement property, improvements they made to their commercial buildings or hotels, etc. They were now able to expense it 100% in the year it was placed in service.
Mm-hmm.
Which is an incredible thing.
It's an incredible thing, and when you look at it over the overall portfolio, it really does drive down those costs.
Yep.
But on a macro level, make a $39 million investment every single year for the next 39 years. We're taking a depreciation deduction on our taxes of $1 million.
Yep.
Yep.
Yeah. If you're a repeat investor, you should be able to recreate in a bonus depreciation environment. You should be able to recreate tax losses from your real estate year after year, each time you reinvest in something new.
In a perfect world, that's straight line depreciation, but under the cost segregation component, you can take a very large amount of that for tax loss. And remember, your interest rates are highest, the amount of money that you're paying in interest. So your tax implication, you're making money, but you're not paying taxes on it, which is one of the huge benefits of that.
Right.
And, get to 4 and 5, and then I have a question on the depreciation of cost segregation, and if it's always done rapidly in the first year, or if there are some fixtures that have to be done over their usable lifespan.
Yep.
but we'll do 4 and 5 first.
Yeah, I can certainly. Yeah, I've got. We'll talk a little bit about a little bit more detail on cost segregation. The next one would be, if you sell Apple stock, you're not going to defer that gain. You're going to recognize that gain in the year that you make the sale. Real estate is the only industry with this potential beneficial treatment with regards to any gains that you generate on the sale of a building through a 1031 like-kind exchange.
Right.
And you can roll your gains for decades into new investments and defer the recognition of that gain and having to pay tax on it. And it might sound a little bit morbid, but if you've got an older investor and they've been rolling 1031 gains for the last 25 years, honestly, instead of selling everything and exiting to transfer cash to the next generation, you want to keep it in that real estate, because when you pass away and it gets transitioned down to your next generation, they get a step up on the basis of the real estate, and that gain never has to be recognized.
So they never pay taxes on the unrealized appreciation.
Mm-hmm.
Spectacular.
Mm-hmm.
He's like it's talking about beautiful cab from Napa or something.
It was like,
Spectacular.
you want to know the
Exactly.
great thing about
But-
dying?
Well, no, but it's all buried in these things, and if you don't know that they're there, you pass them by.
Mm-hmm.
But you can continue to keep the real estate there, and that's why it's so important to consider the gifting component of that.
Mm-hmm. Yep.
And we don't want to go down too big of a rabbit
Right.
hole, but the 1031 theory about getting to a stepped-up basis for the next generation requires you to get to the next generation. In the meantime, taxes are going up.
Mm-hmm.
I mean, in my short lifetime, they have not gone down.
Mm-hmm.
So there is an argument to be made that 1031 is not the end-all, be-all of tax advantages.
It's not, but it's a tool.
It is a great tool.
It's a great
And
tool.
So
All
in
of these things are
that
tools.
scenario, when that person passes away, is there a transfer tax to the younger generation?
It depends on what the value is of the assets that are being transferred. If they're over the lifetime exclusion amount, you could potentially have some gift tax or inheritance tax implications. But if you're under the exclusion amount, you're not going to pay the inheritance tax. And oh, by the way, this property that you bought the first property that you bought in 1975 for $100,000, it's now worth $5 million. That appreciation never has to be recognized by
So
anybody.
when it goes to the heirs, it gets a new basis.
Yep.
And
And
they
the
turn
new
around
basis
and
would
sell
be
it right
$5
away.
million.
Mhm.
So it went to them for nothing, and they're just sitting there with $5 million of tax-free money.
Yep. The
If
fifth.
there's anybody out there that wants to adopt me, I'm still here.
There is somebody who wants to adopt you. I don't think they have tens of millions of dollars invested in real estate, though.
The fifth benefit here is what we call the qualified business income deduction. So as part of the Tax Cuts and Jobs Act, there was this deduction put in place for people who own small businesses or investments through LLCs or S corporations, where it was meant to put the effective rate of tax on that income, that business income, on par with the C Corp rate, which had been decreased to 21%. But essentially what you get to do is take a haircut of 20% of the income earned in that given year as a deduction. So it decreases that maximum marginal income tax rate by 20% on that business income
And
that
that's
you
if you
generated.
operate a business and own real estate as part of that operating business?
It's
or
any
does it have to
operating
be as
business.
part-
It goes for any operating business or any piece of equipment or
Yep.
anything of that nature.
Yep.
Yeah.
Also a beautiful thing.
Mm-hmm.
Yes.
Yeah.
Huge. Huge.
Oh my god.
It is off the rails.
So hot for Trump today. It's
unbelievable.
No,
uncomfortable.
it's not hot for Trump. It's Trump. It's hot for this piece
Tax
of
policy.
legislation in tax policy, which is tremendous advantages and tremendous tools for businesses. They allow them to grow. They allow them to have a little bit of flexibility and continue their operation, and they don't have someone kind of getting in their way to try to mess it up. And the dark side of this is, as we were talking earlier, the Trump that act has a sunset at the end of 2025.
Mm-hmm.
All that stuff goes away and it goes back to what it used to be.
Mm-hmm.
So we're operating in a window of, what would that be now, 3 years, 2 years? 2 years, we're operating in a window that there's
Okay.
a lot of stuff that people should be considering.
It may or may not go away. Let's worry about what is actually
Well,
in
isn't that the
tact
whole
today.
idea of protecting yourself against taxes, is foreseeing the future or what's coming down the road?
Yep.
Am I wrong?
Yep. Yeah, we have conversations with our clients. Let's look at a 3-year projection, a 5-year projection, because in a lot of cases, some of these sunsets that phase out in 2026, I believe, will be impactful from a cash flow perspective.
And I can't believe I'm going down this rabbit hole, is the firm, and I know you probably shouldn't or don't want to speak on behalf of Schneider Downs, but just at a macro level, to Michael's point, are you advocating on a policy basis in order to protect what you think are the best interests of your clients, or are you simply remaining a third party and dealing with whatever rules are and playing by them?
We generally have to advise based on what we know today,
Right.
and so when we talk about a 3-year or 5-year plan, you could make any guess about what might happen in 2024 or thereafter, but we're going to plan for what's in place today, and when things potentially change down the road, we pivot.
Does the firm
But you
know?
wouldn't be doing your job if you didn't tell them this is a potential
But no,
issue.
that's not what my question was. My question was, does the firm think about 3 years, 5 years out and say, the best thing for our clients are X, Y, and Z, so we're going to advocate at a political level to keep these things in place? Or do you stay away from that?
The only area where we would indirectly get involved with lobbying or some other type of influence would be through the PICPA or AICPA and our support of those organizations,
Okay.
which oftentimes put forth sort of we'll say common sense suggestions when those suggestions are solicited by the IRS or legislators.
This is more industry advocacy
Yep.
rather than
Very similar to
Yeah,
our
like
world.
NAIOP,
Like
yeah.
NAIOP or NAR is always saying, hey, red alert, you need to be paying attention to this, and
Yep.
elect officials who are paying attention to it.
Mhm.
So that is a good use of political conversation in the Trade Secrets podcast. All right. So the top 5 are operating expenses, mortgage interest, depreciation. We're going to segue, I think, next into a subset of that.
Mm-hmm.
1031s and QBI,
Mm-hmm.
qualified business. Go ahead. Where are you going?
No, I was going. There's those are all wonderful, wonderful things.
Mhm.
But like anything in the tax code, aren't there some dark side to it? Isn't the
Oh,
Lord
he's
giveth
jumping.
and the IRS taketh
You're,
away?
you're jumping
He's
over.
He's all over.
No,
that.
I
Yeah.
didn't get.
No, we're good. We're good.
We're
We're good. No, we're going to talk about some of the givebacks down the road.
Did he
when
just
you
throw
exit.
Kelsey
Yes.
under the bus
Yes.
on her birthday?
Yeah, that's the.
I think he did.
Yes.
how do
Pardon?
you throw her under the bus?
He was like, I didn't get the memo.
Did you send a memo? Was there a memo?
I got a memo.
There was a discussion.
That is hysterical.
Oh,
Anyways.
it's a discussion.
As I
so
always like to
these
say,
guys don't
suck
listen to
suck.
me. So. Oh,
I'm
okay. So
kidding.
if we're going to get that
She
later,
forgot
I
to-
don't. I don't want to.
she
We
forgot
don't
to-
have to.
We'll-
discuss
yeah,
it.
we'll-
let's
Carbon
save
copy.
that.
We'll
good
get
one
to
till
that.
later
Yep.
because
Yep.
that's like the
How's it fail?
the
All
headlamp
right.
of the oncoming train.
So-
All right.
So
Top 5 of further interest to this conversation, I think, is digging a little bit deeper. And candidly, we talked, I mean, we could have you on just to talk about each one of those 5 for a full 45 minutes, but at the same time, we want to keep it light and fun. But digging deeper a little bit into cost seg, which Totum has taken great advantage of over the last 2 years and is near and dear to our hearts. Where can you kind of dig deeper on that? I think you might
Yep.
even have
Yeah.
an example to talk about.
Yeah, so cost segregation studies, common tool, something we suggest to all our clients when they purchase a building. Doesn't have to even be at purchase. It can be a couple years later when when there might be a reason to generate some tax losses to offset income from other sources or what have you.
Well, you hit a key point right there. This is a cost seg study.
Mm-hmm.
So we're paying somebody, Schneider Downs, to come take a look at a situation and say, here are the opportunities or challenges ahead. This is not going to show up in TurboTax.
No.
No. This is next level
Yep.
accounting.
Yep.
Because Paige with her CCIM cash flow worksheet there, like it talks about depreciation, and it brings up the concept, but then it doesn't really say, oh, by the way, here's this like whole other industry that's just cost seg, and before you can take advantage of it, you actually have to pay someone to study it for you.
Yep.
Yep.
So there are highly trained engineers that will go on site, look at the property, break it down sort of component by component, and there's a whole several hundred pages of IRS guidance that sort of defines what they're able to do and the methodologies that they should use in order to complete their study. But what they do is, say you buy this is a great example. You buy you buy a property and you put some cash into it, construction costs, renovation, etc., to the total tune of, we'll call it $22 million.
Okay.
And what they'll do is they'll break that cost basis. So original purchase price on the existing structure plus any of the construction costs that went into it. They'll break that down into various buckets of assets that might be the 39-year building or the 15-year but eligible for bonus land improvement property, or in the case of a hotel, which is what this example is, you've got your furniture and fixtures that you had significant spend on that all qualify for the 100% bonus depreciation. So they'll go through, they'll do their study. They should provide you as the investor or the a person managing the accounting for the entity that owns the property, a listing asset by asset. Sometimes it's several hundred pages long of all the different pieces of property or units of property that went into that building. And they'll give you, based on their study and the methods that they're required to use, what that life should be, and then what the tax treatment should be associated with each of those units of property.
Okay.
So, and my question was, and you might have covered it and I just need reiteration, but what's the difference? Like, how do you know when it's going to be 100% bonus depreciation where you can write it all off in year one versus what qualifies for an item that would have a depreciation straight line over its usable life?
Yep. So the tax code defines how you must treat your depreciable assets. So your building structure is always going to be straight line 39-year. Now, we talked a little bit about qualified improvement property to the interior of the structure. That's a separate subcategory. But building's going to be 39-year straight line.
And in that's like the shell.
Yep, the shell. And that's a non-residential property.
Right.
Residential properties are 27.5.
Correct. Yep. So you've got a little bit shorter life for the residential properties.
This is like the concrete and the bricks and the sticks,
building
just
shell.
like the
No
outside of
MEP, no
the roof,
anything.
the HVAC systems, electrical,
Foundation.
yep, plumbing. Generally, all falls into that building or building system category.
Okay.
Just a personal question. Site work does qualify as depreciable. Is that correct? Land is not.
Land is not.
Site does.
Land improvements, and there's going to be some specific lines that you need to draw and figure out what is site work, what is excavation, and then what is land improvement. So, your
Excavation
sodding,
doesn't?
your parking lot. It depends on. I think there's actually some really technical rules as far as like how deep down you go in terms of excavation. But like if you're changing the shape of the side of the mountain, that might not be depreciable. But if you're putting in a parking lot and planting grass and pushing a little bit of dirt around here or there, that would qualify as a land improvement, which you'd potentially get your 100% bonus depreciation on. So you've got your defined lives, your defined treatment. So you've got your building, you've got your land improvement, which the code would tell you has a 15-year life, but the code would also tell you it's included in the property that qualifies for 100% bonus depreciation. You've got your equipment. So if it's a commercial property and there's some, electrical work in there that can somehow be tied to the operation of equipment within the facility, that will, you as a landlord, you might have responsibility or ownership over the electrical work. Your tenant has the equipment, but if your electrical work is specific to the equipment, you could potentially throw that in there. The electrical work is a 7-year property, qualifying for 100% bonus. Furniture and fixtures, 5-year, 100% bonus. And so those are the typically the 4 or 5 buckets we see coming out of a cost segregation study. And there's IRS rules that tell you how to treat them.
Outside of the building, what doesn't qualify for the 100% bonus?
The land, you won't
Well,
be able
that's
to
not
appreciate
at
the
all.
value of the land.
Right.
It's today. It's just the building structure.
And everything else can be fully depreciated in year 1.
Everything that those engineers go in and find and categorize in those other buckets.
Was non-building.
That's
Yep.
wild.
How do they treat tenant improvements? So let's say you have a tenant, I'm going to give you $1 million to fit out this space,
Mm-hmm.
and there's the TIs attached. And now, in the past, they took it over the life of the lease. Is that not correct?
You could go down several different approaches to that. It would depend on the terms in the lease. If you as a landlord incur $1 million on a tenant improvement, and you own that tenant improvement, it doesn't transfer to the lessee, then that tenant improvement for your depreciation purposes is treated as yours. If it's to the interior of the property, I would call that qualified improvement property, and you could take 100% bonus depreciation. If you're handing lessee a check for $1 million, different situation. Or if it depends on the language in the lease, but if you've got a situation where it's clear that the lessee has the benefits and burdens of the improvements made to that property, even though maybe funded by landlord, you could have potentially a different treatment there where lessee is the owner of the property and depreciates it. Landlord amortizes the cost associated over the life of the lease. So it all comes down to the language. We would typically advise where that's going to be an expense related to signing up a new tenant, that you would want to make it clear in the language of the agreement. We're going to pay this $1 million for the improvements. We're going to own it. We're going to get the depreciation benefits of it, to make it very clear.
Mm-hmm.
Most leases, unfortunately, don't typically break that out as explicitly, but that would be a best practice that we would advise our clients as the owners of the property to make sure that they're
But if
looking
a
at.
tenant is going to pay for their own build-outs, that is something, even though they don't own the property, they would own the build-out, and the tenant,
Yep.
as a tenant, could depreciate
Yep.
those costs.
Correct. Yep.
That's our next podcast,
And that's
guys.
that's very similar. That would potentially for your if you're representing the tenant and they fund and otherwise own the improvements that are made to the property, they get the depreciation, potentially 100% as qualified improvement property in your one.
I had no idea.
That's why we're doing it. I have a feeling there's a lot of people in this listening audience who don't have a clue about most of this stuff. The $22 million building
Yes.
/ investment,
Yes.
you buy, let's just say it's half and half, $11 million acquisition and then $11 million of improvements. But say there's 5 years in between when you bought the property and when you decided to actually improve the property.
Mm-hmm.
Can you do cost seg the first year and then again in the 6th year?
You can do it. You can do it anytime, but you can do it once.
Okay.
So if you don't do it in year 1, maybe you're generating enough deduction, otherwise to generate a tax loss in year 1, and then say in year 5 you have an exit somewhere else that generated a lot of income or gain, and you don't want to have an outlay of cash in that given year.
Okay.
You can at that point in time have a cost segregation study completed, and we would, from a tax reporting perspective, complete what's known as an accounting method change, which allows you to deduct everything that you could have deducted in year 1 if you had appropriately classified all these different buckets of property.
So you can look backwards to 5 years.
Yep. So you look backwards to year 1, year 2, year 3, you catch it up. And so you can take a huge write-off in the year that you complete this accounting method change to help offset that other event that might be generating otherwise a taxable income situation.
But you can't do it twice.
Can't do it twice. Nope. You get one shot, and you've got some options from a timing perspective.
Just so I can make sure I'm understanding that. So say you buy what if you buy the building in year 1, $11 million, and then in year 2 you do $11 million worth of improvements, but you don't take the bonus depreciation, you don't do the cost segregation study. But then in year 5 of ownership, once it's been improved for 3 years, you have an exit somewhere else that results in 10 million in capital gains, and you don't have any other way to offset that gain. You could go back to year 2 in year 5. You could bonus depreciate in year 5 all of the things that you spent in year 2 for the improvements.
Yep, you catch it up to where you should have been if you had classified those assets appropriately in year 1.
So the cost seg study,
Do you
would
just
say
amend those returns?
You the method change procedures when it results in a favorable adjustment for the taxpayer, you get to take that entire adjustment on that current year tax return. So you don't have to go back and amend. You just blow it through as a deduction item in the year that you complete the study and complete the method change.
So when people come to you and want to do a cost segregation study, do you ask them, like, forward thinking in your portfolio, are you planning any exits that's going to result in a substantial capital gain? And advise them and say, hey, maybe you want to do this that year?
Yep.
Oh, okay.
Yeah. We've got certain clients that we've advised over, several years. Hey, we didn't do a cost seg on this building in 2017. You're going to generate significant taxable income in 22. Or at the time we were, the client may have had break even or losses from 17 to 22. So we're not going to really push it because you're already not paying any tax. No reason to really drive that loss any further if there's not an ability to take it back and recover prior income. So you would say, well, let's hold this in our back pocket until there's a time when we need it. And then in the year that we need it, we'll advise on that and suggest that now's the time to do it.
That's interesting.
Mm-hmm. So this example, great example of cost seg and the power of what that can do for a taxpayer and an investor. $22 million building. That was total cost basis. Of that, approximately $7 million went into improvement, and that's excluding the cost of the F&F, the furniture and fixtures. It was a hotel, and also the land improvement. So originally went into service in 19 before the CARES Act fixed this rule with regards to the qualified improvement property.
Okay.
So we weren't able to take bonus depreciation, the 100% expensing, on our 2019 tax return related to the renovation costs of this building that went above and beyond original purchase price.
Sure.
CARES Act came in. They issued some procedures whereby taxpayers could now go back and amend those 19 returns that were filed in March or April of 2020 and take advantage of the fix that was put into the CARES Act legislation that allowed qualified improvement property to qualify for bonus. So originally, we had $13.5 million allocated to building. CARES Act comes out. We had done a cost segregation study. We said, guys, you need to go back out there and revise that study because now we can take bonus on all this additional property. And ultimately, we ended up moving, of the $13 million in the original study, we moved another $7 million to qualified improvement property as a deduction in year 1. So it was $7 million plus $5 million on the furniture and fixtures plus another $1.5 million on the land improvement. So add that all up, you're looking at about $13 million of deduction in year 1 on a $22 million property.
Can that deduction only be used retroactively, or can you save it for future years?
It depends on your tax situation. So part of the CARES Act also allowed taxpayers who generated a loss in 19 or 20 to go back and carry back that tax loss to previous years and get refunds if they had paid tax.
Okay.
Sorry.
Yep. You could elect out of that and carry it forward to offset future income. In this example, it was perfect timing, generate the loss, carry it back, generate some significant refunds at a time when cash was needed due to COVID.
Yeah.
Incredible.
Wow.
Yeah.
But it still can be carried forward, though.
It can be.
Yeah.
Yep.
And is there any
Sunset on that?
sunset on that?
Mm-mm.
That's an amazing thing.
No, it used to be 20 years and it would expire. That limit is now gone. You can carry it forward indefinitely.
All right, so I feel like we could deep dive into any one of these topics a bunch, but I know Michael he wants to be the bad news bearer.
It's not bad news. It's just you should be aware of it.
to kind of round out the conversation, at least for tax
Send
episode
on a low
1.
note with Michael.
No, we'll make it happy before it all comes to an end. But drum roll.
Well, it's recapture. When you finally do have that day of reckoning, now you can transfer that in the form of a 1031, correct?
Mhm, yep.
Transfer that. But if you have a taxable event, the IRS gets to come back and say, okay, you took all these losses, you did this, we were so nice to you, we did all this stuff for you, now I want my VIG.
Mhm.
And can you please explain that?
We'll use the same example. Right?
Yeah, so in that case, the issue is that the property that would qualify for bonus depreciation is what, and I'm sorry to reference the tax code, but it's what we would call 1245 property. And it's your personal property, the stuff you took 100% bonus depreciation on. When that is sold, to the extent that some of the purchase price is allocated to the property where you took 100% bonus depreciation, you're going to have to recognize that gain as 1245 recapture. And that gain, that portion of the gain that falls into that bucket is going to be taxed at your ordinary rates.
You get that? It's
I
not
think so.
capital gain, it's income,
Yep.
correct?
So
Yeah.
all the savings in this cost seg study on the $22 million hotel, if in the next year they sell it for $22 million again, just to keep it simple,
Mhm.
anything they depreciated or took advantage of as a loss, they now have to pay ordinary income on as part of the disposition of the $22 million.
In general, the bonus depreciation stuff, that's going to come back in as ordinary income in the year they sell it.
Yeah.
When you're negotiating purchase price on that exit, there are two buckets you want to try to push as much purchase price to as possible. One being land. As the seller, you want to put as much to land as possible because that will just generate cap gain based on the difference of the cost basis in the land and the value
Sure.
attributed to the land. And also building. So the building that gets depreciated over 39 years, when you recapture that depreciation, you get a friendlier rate. It's not the 20% cap gain rate, but it's the 25% unrecaptured Section 1250 rate. So to the extent you allocate purchase price to the building and you've taken depreciation on that building over straight line 39 year, when that's recaptured, you pay 25% on the amount of recaptured. Then beyond that, if there's additional purchase price beyond the original basis, that's capital gain. But all your personal property, if you, in your negotiations, allocate purchase price to your FF&E, to your land improvements, whatever, potentially that's going to come back to you as 1245 recapture at ordinary rates. So you want to, there's a negotiation there. And on the flip side, the buyers, they want as much to the bonus property as possible.
Right, because then they can.
Yeah.
And then the cap gain, there's another part about that if you go over a certain amount, isn't there the Obamacare tax kicks in?
Oh, yes. Yeah.
Okay, so it's not really a 20% cap gain. You're dealing with a 23.6% cap gain.
Mm-hmm.
You start adding up these numbers, they get to be fairly significant.
Yep. Yeah, and if you're involved in the business, if you're that real estate pro, and you've got what we call material participation, you're not going to be subject to that 3.8% net investment income tax from the Obamacare legislation.
You're off the hook, buddy.
But if you're just a
depends on what you sold,
general
though.
if you're a general LP investor and you're not involved in the business and you get allocated gain from the exit on your K1 or whatever, you are going to be subject to
But
that.
that's for the real estate related income. Is that
Mhm.
not correct?
Yep.
If it were for something like a capital gain based on a stock transfer, you would be subject to that.
Yes, yeah, you're all if that's a good comparison there. Where if you're involved in the rental real estate business, you can avoid that 3.8% based on how involved you are. You're never going to escape the 3.8% tax on your sale of stock, your interest income, etc.
You can use your losses to go into other diversified components of your portfolio, but you could only avoid that particular tax if it's real estate related. If it
Yep.
goes to something else that you did that had a taxable event, then you get hammered with it.
So, I mean, not to dumb this down, but it seems like this is just, these cost segregations are just another way to like kick the can down the road.
That's
and
true.
does it get worse? paying the ordinary income tax at the end when tax rates, as Kevin mentioned earlier, don't generally go down. So is there ever an instance where you would say to someone, maybe bonus depreciation in year one doesn't make sense because we're going into a democratic 4 years, you plan to sell in the next 4 years, and they're going to rake you over the coals with your recapture tax rate?
No, that would, if someone...
as a loose example.
Right, yeah, no.
Example.
That's,
Maybe, what if?
Absolutely, that comes up in conversation. So if there's a 3-year horizon on the property, and they don't need to generate losses in year 1, year 2, and they just sort of want, a consistent tax result, then we won't force a cost segregation, the cost of a cost segregation and everything else on them. What could, you mentioned kick the can down the road. Theoretically, if we stick with that hotel example, you get the benefit all in year 1. The FF&E related to the hotel is not going to be worth anything 10 years down the road. So hopefully at that point in time, you're not allocating any purchase price or any significant purchase price to the FF&E to have to deal with the recapture. So you do end up overall in a better position where you took those deductions at the ordinary rate, and you don't have to recapture much of it at that ordinary rate. You recapture at the 25% rate until you're above and beyond, and then you're in the cap gains rate at 20%.
But then there's always you're kicking the can down the road is a very bona fide strategy, because it's always, what is your money worth today versus what's your money going to be worth tomorrow? And if you do get to that ultimate end, when you can actually, if your gift tax and your transfer tax would be large enough, you would be able to avoid taxes up to a point of, and currently right now, if you did it, you could avoid it $11 million per person.
Mm-hmm.
Now, so if you do a cost segregation, can you elect to just take bonus depreciation on the FF&E that in 10 years will have value?
Yeah.
Yep,
And not do it on the land improvements and things like that to avoid that recapture?
Yep.
Ideally.
Yep, you have the ability to elect out of taking bonus depreciation on each of the classes of assets. So you can take it on the FF&E and not on anything else if you want to. And that's where you would get involved in some sort of significant planning and projection type work to figure out what that might look like and what the benefits of that would be.
So, bringing it full circle, we started with Bitcoin and FTX bankruptcy. I think suffice to say, this has been a great conversation about how important tax is to real estate investing. Like, one can't happen without the other. And for anybody who's listening, if you're investing in real estate, you need to be talking to somebody like Dave on a very regular basis, because we certainly only peeled back like the first layer of the onion, not the multiple layers. So it's been awesome. Bourbon. This was the first time we did Blanton's, which everybody thinks is like the best, hardest to get.
I think it's like tried and true.
Yeah.
Just like an Old Faithful.
Just like an Old
I
Faithful.
vote yes.
Oh, I like it. Blends is a Buffalo Trace product.
Yes, Michael
As
always
usual.
reads the bottle.
Vanna White over here.
You get the little thing. What was our letter today? The letter.
It's not.
Oh, our letter is an N. Okay, so there are 8 different horse tops or bottle tops that they have, and they're all in different stages of a horse race if you collect them together. And each one of them has the letter of Blanton's. This was an N, but it's not the one of the N's has, yes, the N has the, what do you call that, an umlaut?
Yeah, Matt's
The apostrophe?
driving nuts right now from that bottle in the microphone.
Yeah, so.
This like sounded like a freight train,
but,
probably.
Keep spinning it.
Anyways, we're not gonna figure out the whole race, but I think the N's the easiest one to get.
The N
is what I'm heard.
Is
or
that
what
true?
I've heard.
Yeah, but
The
there's
N's the easiest
so
one to
there's
get.
people that can collect that, and it's a great place.
How about you, Dave? Winner? Or
Yeah, it's
loser?
good. I'm not a huge bourbon connoisseur, as I explained, but I said put it in my cup and I'll drink it, and I didn't make any weird faces when I took a sip, so we're good.
We could fix
That's
that.
more than any of us can say. And there is one on that
There's
shelf
one on that
that
shelf.
would
We
take
can-
you down.
We can change that.
We got the weird
We
face.
had to stop filming a podcast because we all tasted it beforehand and like simultaneously all 3
She
of us
actually
gagged.
asked for a bucket.
Oh, good.
Yes.
It was, well, I didn't ask for a bucket, but I was never going to take
Her
another
body
sip
language
of that.
was asking for a bucket.
Yeah.
All right, last thing. So now that we've started taking guests and we have a great name, what is your trade secret? Like, if you look at your career or your current business or Schneider Downs' success, when you hear trade secret, what's that mean to you?
Trade secret to me means not being afraid to take on something challenging. I feel like every time I've grown in my career or helped clients in a significant way, it's because we took on some sort of significantly challenging project and weren't afraid to do that and to experience something new that we could learn from and then apply in multiples down the road. So I would say it's not being afraid of a challenge and moving forward and learning.
That's awesome. That is fantastic.
I love it.
All
This
right.
was great. This was, I mean, I am fascinated with your memorization of the tax code. I'm sure you've had many wild Saturday nights of reading, but that's really impressive, and I found this super interesting. Hopefully I'm sure other people will as well. But thanks so much for
Yeah,
coming.
glad to be here.
This is
Thank
great.
you.
Yeah, cheers.
Thanks
for joining
Thank
us.
you very
Yep.
much for joining us.
Thank you. Thank you. Thank you.
Our
Alright.
savior
That's
against the IRS.
That's so. Oh, right. Yeah, I can't have a single tax conversation without hard alcohol ever.
Well, now you should be excited about tax versus I used to loathe it.
Oh, no, tax is
no,
fascinating stuff.
It's fascinating. I mean,
Fascinating.
All right, Paige is going to start investing in real estate, start taking advantage of some taxes.
I'm gonna call my friend Dave.
Yes.
Mm-hmm.
And to our fans out there, we look forward to seeing you soon. And it'll be episode 18 next time. So, all right, happy birthday to Kelsey. And that's a wrap.
birthday.
Talk to you soon.
Yeah.